Good morning, everyone. Welcome to our December 3rd, 2020 Retirement System Investment Commission meeting. I'd like to call the meeting to order. And the first order of business is to adopt the agenda as that has been presented. So can I have a motion for that, please?
I move.
Second.
Peggy's a second. All in favor, please go by saying aye.
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 Motion carries. We have an agenda. Next item up for a motion is can I get a motion to approve the minutes as they are now presented.
Mr. Chairman, if I could for just a moment.
Sure, go ahead, Mike.
Just wanted to let everyone know, and you should have, I think many of you probably seen that we did revise the minutes somewhat, and they were posted again. I believe last evening the revised minutes were. There were evidently there was a few technical errors in the minutes that needed to be corrected. I think just as a result of the COVID and everyone working remotely as to how they got put together. So that has been done. And also Mr. Condon had indicated that he wanted to see there was a question that he asked Kendall Gates about the assumed rate of return. The question was reflected in the minutes, but Mr. Condon's answer was not reflected in the minutes. So they were revised to include that as well. But I just wanted to make sure that everyone knew that there had been a recent revision to those.
Okay, folks, that said, I'm hoping everybody got it and had time to get through it. And I'd like to make a motion to accept these as they're currently presented. A motion to accept the minutes of the September 2020 minutes of that meeting. Can I get a motion, please?
So moved.
I have a motion.
Second.
Second. All in favor, please indicate by saying aye.
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 Motion carries.
Mr. Chairman,
Yes.
as commissioners, if you would just indicate if you're making a motion, just for most of the time we can recognize your voice, but just in case, if you would indicate who you are, so we're connecting. Yeah, I thought that's right. I thought that's who it was, Reynolds. Just make sure that we're in the minutes for this meeting that we're connecting the right commissioner to the right motions. And also for everyone on the call, please make sure that your mics are muted if you are not currently speaking. Thank you.
Thank you, Mike. Next on our agenda is the chair's report, and I don't have any information to present at this time. I'm going to defer to the CEO to see if I'm omitting anything. Mike, if I left anything off, is there anything that any information that should come from me at this point in time?
No, sir.
All right. Next, we're going to move on to the committee reports. And again, I'm going to defer to Mike. You kind of quarterback. Has there been any information come out of committee that needs to be brought to this commission today?
Is there, Rebecca, anything that you have, or is there anything from the Human Resource Committee? I don't believe there's anything from the Human Resource Committee, but is there anything from the Audit Committee?
Yes. Thanks, Mike. The audit committee report has been posted on WatchDocs in advance following Bill Hancock's wonderful solution to that as a previous chair. So if there are any questions about it, I'm happy to answer them or try to answer them or refer people to Mitchell. So.
All right, folks. Rebecca has brought our attention to the minutes or report of the meeting that the Audit Enterprise Risk Management Committee had on October 7th. The notes and the minutes to that meeting, they have been published. Any further questions, as she indicated, please go back to her or see Mitchell about that. Do we have any other discussion on that report? If not, let's move on to the CEO's report, and I'm going to recognize Mr. Hitchcock.
Thank you, Mr. Chairman. It's my pleasure to introduce a new staff member that has recently joined us in our analyst development program. His name is Daniel Davis, and he comes to us as a new junior analyst. Prior to joining us, Daniel was a business development analyst at Deloitte and a portfolio implementation specialist with Vanguard, which are both located in Charlotte, North Carolina. Daniel received his Bachelor of Science in Finance, Management, and Marketing from the University of South Carolina in 2017. And we look forward to his service and seeing great things out of Daniel as he works his way through the analyst development program. So welcome, Daniel. Also, Mr. Chairman, I've had a couple of questions about the meeting schedule next year. Traditionally, we would have adopted the meeting schedule for the subsequent year, given that this is the last meeting of this calendar year. But I would just like to call everyone's attention to the fact that we have handled that, or basically in perpetuity, through the adoption of our strategic calendar. The strategic calendar sets our meeting dates, and they're based on, and again, we've set our meeting dates in accordance with the availability of quarterly information that we have in regards to performance. So those are all set based on a particular Thursday in the month of which they occur. But I will, for purpose, and these will be posted on the website as well. But for purposes of this meeting, just wanted to let everyone know that our March meeting, which is the first Thursday in March, will be March 4th, 2021. Our April meeting next year, which is the third Thursday, will be April 15th, 2021. Our June meeting, which is also the first Thursday, will be June 3rd, 2021. Our meeting, which is the second Thursday, is September 9th, 2021. And our December meeting, which is the first Thursday of December, will be December 2nd, 2021. So again, those meeting dates will be posted on the website as well, but just wanted to let everybody know what, remind them of what they are, so you can calendar accordingly. That is all I have, Mr. Chairman.
Thank you, Mike. That's all you've got. I'm going to move on to the next item on our agenda, which is our Chief Investment Officer's report. I'm going to recognize Mr. Jeffrey Berg now.
Thank you, Mr. Chairman.
All right, there we go. Sorry, Jeff was muted for a second.
Okay, I hope everyone can hear me okay. So during the quarter ending September 30th, markets continued to recover across the board very strongly, and our portfolio was up roughly 5%. As you can see here, the policy benchmark was up 5.4% during the quarter. Also during the quarter, the net impact of benefits had a very small impact on the trust during the quarter. But we like to show the detail under the hood. So far, as of September 30th, there have been over $1 billion of total requisitions versus $921 million of deposits. I also want to make special note of the $110 million legislative deposit that came in, I believe, in July. And then investment returns represented a growth of over $1.5 billion during the quarter. So, hold on one second. Make sure that you're sharing your screen, because I'm getting a. Okay.
I got a message.
Okay. Apologies. Please give it just a second.
We're just gonna take, if it's okay, just take a couple minute break. Evidently, we have some latency in what people are seeing on their screens versus what, as we're moving through the presentation. So we're gonna make sure that, everybody can see what we're seeing. So just give us a couple of minutes, if that's okay.
Well, up to a 5-minute break, folks. We're just having some technology issues.
Again, just one more time, if everyone who is not speaking could mute their mics, because we're still getting a decent amount of background noise. So, thank you.
All right. Can you see? Oh, okay. Okay, I'm pretty sure that everyone can see this. So, all right, let's start this again. During the quarter ending September 30th, strong quarter for markets in general. Our portfolio was up 5%. And as I hope everyone can see on this page, the policy benchmark was up slightly more than that at 5.4. This was the detail I was referring to about benefits. We had over nearly $1.1 billion of total requisitions, $921 million of total deposits. Also, the $110 million legislative deposit in July, and over $1.5 billion of gain from investment returns. So,
Jeff, this is Bill. What is that legislative deposit? What's the purpose of that, and is that recurring?
Bill, what the General Assembly did whenever they initially started raising the contribution rates with the pension reform bill is they, in essence, cover 1% of those contribution rate increases. So that's representative of that. So the state is kind of covering one of those 1% increases. So that's when we've kind of separate that out as legislative inflow. Because that's coming more directly from the state to cover the increases that 1% corresponds to. It's not,
Okay.
in essence, it's not extra money in regards to how the contributions increase. It's just that it's a recognition that the General Assembly has, taken upon itself to cover 1% of those, if that makes sense.
Okay, thanks.
okay. So this page is probably the easiest way to observe the effect of simplification in our portfolio. No longer are we looking at 18 asset classes, but rather at 5 main and Portable Alpha as well. So at a high level, every asset class had a strong quarter when compared with our long-term forecasts, with the exception of real assets. I will get into this in greater detail in a moment, but our public markets asset classes all performed well versus their benchmarks, while private equity and debt portfolios lagged theirs. Also, on the topic of our Portable Alpha hedge funds, they added value, and as a reminder, that means that their return exceeded the return of cash during the quarter. What that represents is we are better in the quarter as a result of having used Portable Alpha as a strategy. The figures you see here for Portable Alpha hedge funds are not the returns, but rather those excess returns over cash over the relevant time period. Sorry, just had an echo. So let's look at asset allocation at the end of September. I want to make sure to note that the portfolio has remained within the allowable ranges in all asset classes and is compliant with all constraints as outlined in the AIP SIOP document. We'll get into asset allocation in greater detail in a few moments. Now, let me move into the deeper analysis in the quarter. So there are three high-level questions that I want to be able to answer and answer very clearly for you every quarter. What outperformed, what underperformed, and what was essentially in line during the quarter. So there were three things that worked well during the quarter. First, we were underweight core bonds in the quarter and overweight both public equity and credit. The second positive is the Portable Alpha program, which I already alluded to. And third, we had some very strong excess returns in our liquid real assets portfolio. Two things I alluded to already that hurt returns in the quarter: the performance of our private equity portfolio. We'll talk more about that in a minute, as well as our private debt portfolio's return, which was actually a fair return, but it underperformed its benchmark by a good amount. That benchmark is listed credit that is lagged 3 months. So in this quarter, is capturing what was essentially the fierce recovery. Turn off the speakers. The fierce recovery in April, May, and June. Needless to say, that was a very strong period for a credit recovery, and the benchmark was up 10% during this quarter. Three things that performed as expected: public equity portfolio. The point to make there, that is now a passive portfolio. It did what we expect an index fund to do. Our bonds portfolio, aside from the core underweight, which I've already hit on, that portfolio did exactly what we expected to. And finally, we continued to hold REITs and listed infrastructure in our real assets portfolio during this quarter. The combination of these really didn't give any meaningful different return than the benchmark, which is private real estate. So let's move into our framework. So here we see the high level data through the framework. 70-30 portfolio, not at all surprisingly, continued to have a strong quarter, as did each of the portfolios. The portfolio structure impact was positive during the quarter, but manager selection was negative, and let's drill a little deeper into that. Here are the components of portfolio structure. The significant impacts here relate to the use of Portable Alpha, which added 24 basis points at the plan level. Our bonds portfolio positioning was also an important impact. We're going to get into the details of that composition in 3 slides when we look at the sub allocations. Here we see the manager selection impacts. You can already see the impact of our shift to passive exposures in the small but positive outcomes from equities and bonds. The bigger impacts here are negative and relate to what I just referred to, the underperformance of the private equity portfolio and the performance of private debt relative to that very strong benchmark. I want to pause here for a moment just to remind everyone that we have engaged Makita to conduct a review of our private equity performance history in order to help shed some light on the underperformance that we've been experiencing over the last couple of years. It's been a meaningful detractor from the overall plan return and worthy of study. So we expect them to conclude this work in advance of the next meeting and plan to discuss their findings at that time. Now let's look at the portfolio asset allocation. Here we see asset allocation along with the changes since the last quarter. A few things that I think are worth spending just a moment on here. One, I want to point out that our private equity exposure is well below its 9% target. The main reason for this is that between 2012 and 2017, we had undercommitted fairly meaningfully to the asset class. We have accelerated commitments in recent years in order to move this back higher, but this is going to take some time before we expect to see the impacts from these newer investments. Secondly, we remain overweight asset classes with higher expected returns like equity, private debt, and real assets, and underweight core bonds. Think of this as being cautiously bullish. Now, why are we cautiously bullish? Despite there being very obvious risks in the world today, specifically relating to COVID-19, I think it's important to reflect on the fact that 3/4 of the world's central banks have set their policy rates below 2%, and as of 2 weeks ago, more than $17 trillion of global debt offered investors negative yields. Since April, these forces have been a powerful tailwind for risky assets, and I don't expect that to stop. But we are being prudent, and we aren't making very large bets with the portfolio. So let's dive into the bonds portfolio for a moment. There are two themes that I want to touch on here. First, we are underweight bonds, which you can see on the left-hand side. The target is 26, our weight is 23.3. This is largely due to being overweight those other asset classes, most notably public equity and private debt. The second thing I want to highlight is that we have continued to hold some non-legacy exposures. You can see this on the right. We are holding roughly 2% in emerging market debt, as well as some non-investment grade credit in the portfolio. I made that decision that we would continue to hold these exposures after June 30th, even though they no longer were a part of the policy portfolio, because they had been beaten up so badly in the first half of the year. They have recovered very nicely during the quarter and since the end of the quarter. And this has been very, very helpful to the returns. Now we have begun to slowly reduce these exposures as the yields approach levels that are no longer as compelling. Let's look at the equity portfolio for a moment. This is a portfolio that is.
Excuse me, Jeff. This is Ron.
Yes, sir.
Would you go back to the bonds breakout just a second?
Absolutely.
I have the impression that part of our bond investment is other forms besides bonds themselves, options and that sort of thing. Could you tell us about that part of the bonds portfolio?
Sure. Not options, but futures and swaps.
Okay.
At this time. So yes, we do have synthetic fixed income exposures. So think of this as treasury futures, swaps that deliver us the return of our benchmark, the Bloomberg Barclays aggregate index. So we do have those exposures that are, we call those synthetic, and that is in order to have the Portable Alpha program. So, but think of those as passive exposures. Those are not managers choosing securities. Those are just, futures contracts or swaps that deliver us the return of those instruments or indices. Is that helpful?
Yes. I'm still learning about that, but I gather that in your view, this doesn't increase the risk of the bond part of the portfolio.
Whether we have the exposure in actual bonds or in and I'll use the swap contracts as an example. I don't feel that there is a material difference in risk. Now, let me zoom out for just a moment. The reason why those exposures are largely fixed income, those synthetic exposures are largely fixed income. If I can have you recall earlier in the year, we talked about making some changes in order to de-risk the liquidity risk of the plan. We wanted that beta overlay, meaning those synthetic exposures, to be more conservative instruments, so that it would help us risk mitigate from a liquidity management perspective. So I'm answering a slightly different question than the question you asked. I want to make sure I'm admitting that, but I think it's an important kind of base layer to that question. Now, specific to the fixed income exposures, I don't see the physical security versus the synthetic instrument as presenting a materially different risk. However, please do understand, and we're going to hit on this point in a few moments when we get to the risk slide, that portable alpha is a strategy that will deliver more risk than if we don't have it and we just hold those core bonds and earn those yields. So we happen to think that it is a particularly effective way to gently ratchet up the level of risk for the plan. But it is that, I would say the risk is more on the alpha strategy side than whether our bonds are physical bonds or synthetic bonds, if that makes sense.
Yes, thank you, Jeff.
Okay. So looking at the equity portfolio, this breakout on the right-hand side is what the benchmark looks like if broken down into subcomponents, which we wanted to do in order to help articulate the small differences that we do have between our portfolio and the index. And those simply flow from residual investments, from the legacy investments that are creating these small weighting differentials, but these are going to disappear over the next few months. And these are strategies, by and large, strategies that were in place that we are working our way out of, and trying to do so in a way that is advantageous to us. So this page now only has one block comment on it, largely because I can't think of a whole lot to say to make an index fund exciting, but I do want to make sure that you understand it may look like a lot of complexity, but what we're really looking at is an index broken out into its constituent pieces.
Yeah, just
Sir.
piggyback. What you see under the hood there basically is just, if we broke out ACWI into its geographic components and exposures, that's what we're seeing under the hood there. That's ultimately the makeup and the diversification that you get through ACWI, right?
Yes. Yeah. Okay. So
I just joined the meeting, by the way. Sorry.
Great. So let me.
Jeff, this
Yes,
is
sir.
Bill. I've got a question about that slide.
Yes, sir.
So private equity there shows a target of 6.8%, but as you just referenced, it's really 9%. We're just, the way I understand, we do something a little bit different there. So we're really 2.2% underweighted. So that it looks like you then throw that 2.2% up into public equity policy target. Is that right?
Exactly.
Yeah, Bill, if you'll recall, when we adopted the SIOP, one of the things that we did with asset allocation is we recognized that although we wanted to get to a 9% weight to private equity, that we were underweight significantly to that target. So, and the thing that we don't want to do is we don't necessarily, although we've certainly accelerated our allocations to private equity managers over the past couple of years in order to try to get to that target weight, we don't want to do so at a pace that we would find where we would ultimately be harmful to the plan. So the SIOP allows the weight to private equity in particular to float until we get to that 9%. And then in a subsequent SIOP, once we're kind of in a steady state, have the ability to stay at 9%, we'll take that floating weight off, and then the target will be 9%. But what the SIOP talks about too is if we're underweight, as you saw, if we're underweight, whatever percent we're underweight private equity, that's made up and that's basically added to the target to public equity. So
okay, so I understand that. Where I was headed, that was kind of a preliminary question to where my next question is. So when we rebalance, and then maybe we'll follow up on this later when we talk about rebalancing, when we rebalance, it probably just says rebalance to the target. Are we rebalancing to the target of 46% to public equity? Or to this now kind of moving target?
Let's call it an adjusted target.
Yeah, Bill, basically what happens is that we don't, whatever the actual weight that we have to private equity at the time that we would do the rebalance, the difference between that and 9% is simply added to the target weight for public equity. So we would rebalance to that target as far as public equity is concerned. And because basically when you're rebalancing, the only two levers that you really have to pull for asset class purposes are public equity and bonds. So if, once we get to 9%, the target on private equity, the target weight to public equity is 46, actually. So given that it's, 6.8 now, we just add that 2.2 to 46. So we're trying to get more towards 48.2. Does that make sense?
Yeah, no. So, and that's what I figured the answer was. I mean, if we didn't balance the 48.2, we'd have 2% out there not invested somehow.
Yeah.
But
it would just, so
Higher
that's
cash.
cash or something like that.
So I figured that was the answer. I just where I'm headed is I just want to make sure when we ultimately get to our rebalancing language that it's clear that we're rebalancing, or maybe it is somewhere else that public equity target can be a moving target.
Yeah, and that's clear in the SIOP, Bill. Yeah, Bill, that's in the SIOP as it exists right now, so that's clear.
Okay.
So regardless of whether we rebalance monthly or quarterly, that's the target. That's clear that's clearly stated in the SIOP.
Okay, I'll look at it just to make sure, because that's not something I probably picked up on before. Okay, thank you.
Okay. So let me close with our risk estimates. As a reminder, we are looking at the current portfolios as opposed to the portfolios as they evolve over time. So we are looking at the portfolios as of 930. And for reference, for policy, for implementation, and the current portfolio, these risk statistics show us the volatility of those portfolios held as they exist today for the past 2 years. There is no DK employed. So what that means is that the volatility you experienced in late 2018 is weighted exactly the same as if it occurred yesterday. So here you can see that we are currently employing more risk in the implementation benchmark than we have in the policy benchmark. This additional risk is coming from 3 main places. First, we are using portable alpha. That shows up in the implementation benchmark, but is not a component of the policy benchmark. Second, we have more credit exposure, as we just saw in our bonds portfolio. And third, we are overweight slightly to public equity and more meaningfully to private debt against an underweight for core bonds. So another thing that I want to hit on here, we recently had a good discussion with Mr. Condon about some questions that he raised, and I think it could be beneficial to share those with the commission. Mr. Condon noted that the policy benchmark was showing a greater level of volatility than the reference portfolio, but that our discussions during which we were setting the asset allocation policy target last year suggested that we should expect to see these as roughly equal. And is this something that we need to be concerned about? So yeah, a few observations that I think are helpful relating to this issue. One, Makita's forecasts for risk and return are 20-year forward-looking. The data on this slide, however, is showing us 2 years of rear view mirror historical experience. And based upon some preliminary work that we have done that looks at how these different portfolios' risk levels change over time, we do see that they change over time, not only in level, but in rank. So the conclusion that I would draw from this is that looking at this as at a single point in time would wind up simply leading somebody to draw could wind up leading somebody to draw a conclusion that would be simply a function of when they happen to look at that risk. So an example of how this can and does change, at the March meeting this year, this slide that we showed you, this slide in this framework, at that point, the data was as of December 31st, 2019, and the standard deviation of the policy portfolio was lower than that of the reference portfolio. Actually, both the policy and implementation benchmarks were showing lower 2-year historical standard deviations than the reference portfolio at that point in time. So, what do we do with this? I think Mr. Condon raises a good point. Rather than simply concerning ourselves with a point in time, it can also be helpful to see how these risk levels evolve, again, both in magnitude, but also in rank over time. So we're going to work on a way that we can show that to you in the future. Bill, I want to make sure that I'm being faithful to the conversation. Is there anything that you would add to that?
Yeah, a couple of things. I mean, everything you've said has been right on target, and so I appreciate that. Yeah, so just expand on the last thing you said a little bit. You know, for instance, it seemed to me that, and I think Jeff agreed, as he just said, that if 8 years from now, the reference the policy, if a measure of the standard deviation from the time we adopted this framework, July 1, 2020, to 8 years, 8 years into the future, or 8 years from now, if these reference and policy standard deviations continue to diverge, that may be an indication that we need to go back and look at those and possibly consider resetting them. So that's kind of the historical measure. The other thing, it just stands out, and Jeff said it, but this is a different measure of standard deviation, a 2-year rolling average versus a 20-year forward measure that we looked at when we adopted this plan. And it was the reference portfolio that we adopted was supposed to have an 11.7% expected volatility 20 years, over the next 20 years versus this rolling 2-year past of 14.42 now. So that's a stark difference, but it's a different calculation. My biggest concern is and I'm not saying we change anything right now, but I think it's something to think about, and it's certainly a little bit concerning to me that in our reference portfolio, we selected the highest allocation to equities that we could, 70%. And so we accepted a lot of risk, and we probably all agree, maybe begrudgingly, to do that because we need more return. But maybe it was just an assumption on my part, or maybe I just didn't even think about it. But if we're accepting 70%, well, I did think about it because I know I sent an email about it, but I wonder if that reference portfolio ought to kind of top out our risk. If we're already accepting the statutory limit of 70% equities, do we want our risk to go much higher than that? And so when I see the policy portfolio higher than the reference portfolio, I see the implementation risk higher than the policy, and the actual higher than the implementation. And overall, there's almost a 2% difference. That's a significant increase in risk when we're already choosing 70% equities. And I know there's not a statutory limit on what we can do with the other 30%, but I think reason would tell us, I think reason told us that should probably be core bonds. Anyway, the stark increase in risk from the reference portfolio concerns me when we started with a reference portfolio at a high level of risk. And I don't know if anybody else has any thoughts about that, but that's just something that concerns me that I want us to pay attention to. Thank you.
Bill, this is Mike. I think it's a good point that you're making, in regards to the amount of risk that we assumed. And, I think it kind of harkens back to, how we describe the action that we've been taking, in reaction to a low interest rate environment that, when we sent the letter over to the members of the SFAA, the problem that a low interest rate environment produces for savers like us is it does require you to take more risk in order to, to try to get a rate of return that you feel like will help make your plan work. But, the one thing that I will say is, that I would caution, as Jeff did, against taking any of this as just a snapshot in time, right? Because if we look back to December, the December numbers that Jeff alluded to, the reference portfolio actually, other than the actual portfolio, the reference portfolio was 8.47%. The policy was 8.14. The implementation was 8.37, and the actual was 8.9. So they were all, sub 9 and below that 20-year forecast of 11. And, that was right on the cusp of us about to have a earth-shattering market event. And that earth-shattering market event, both the precipitous drop in the markets as well as the likewise rebound, are now figured into that 2-year number. So I think what you see is you'll see the variations in this over time, because at the end of the day, what we're thinking is that it averages out to that level of risk over a 20-year period. And one of the things that we've seen is we've seen some preliminary work where we pushed this back 20 years, and it's not quite ready for prime time yet, but we've at least done one run through of pushing this back 20 years. And what you see is, all of these portfolios pretty much move up and down together, and that sometimes one's higher than the other, just depending on the circumstances. And that, with the 2-year period, the 2-year look back, you're going to have a greater degree of fluctuation, but they all move together. Sometimes one's more than the other. But I think but trying to present this more cumulatively rather than just a snapshot in time, I think will also be beneficial for us to make that ultimate decision as to whether or not we're taking the right amount of risk.
Yeah, I agree. Thank you.
Yeah.
So Bill,
Just
another
the one
point
thing I'll add is as Mike said, yes, if we want to achieve, if we're trying to achieve the assumed rate of return, then yes, we are required to take the risk. But of course, I think our duty, and that was my question to K&L Gates at the last meeting, are we required to take that risk, or do we make our own assumption, determination about what level of risk is prudent? And they basically answered the latter. So yes, if we're required to take the risk if we want that assumed rate of return, but it is up to us whether we assume that risk or not.
Yeah, and
Right.
yeah, Bill, like we talked about too, I think that's a good point. But the one thing that I think is incumbent upon us is if we ever get to the point where we make that decision that the amount of risk that we're willing to tolerate doesn't yield a return that we reasonably expect to get above the assumed rate, then we have an obligation to communicate that.
No doubt.
So yeah, that's I think there's two pieces I think to that fiduciary duty is we have to communicate. We need to make sure that we communicate that to the plan sponsors, and our co-trustees as well, so that everybody is on the same page when it comes to that risk reward that we're willing to take.
And I think discussing it like this in a public open forum is part of that communication. Discussing this tension that really the entire state is having on this issue is I think is part of that communication.
Yeah.
Sorry to keep interrupting, Jeff.
Oh, no problem. So, but
Jeff, can I just chime in here, because I do think this is an important issue, right? And I hate to keep harping on it. Some of this comes back ultimately to reporting, right? Anytime, because essentially we're dealing with issues of multiple time horizons, right? Like assumptions that are set on one time frame, measurements that are reported on maybe a different time frame. But, you also, I think, any sort of risk process has to know the base assumptions, right? Understand that you're working with variables that are going to have error terms, around them, right? But you want to be testing those assumptions and have a process that ultimately sort of documents, okay, I've had an assumption violation. Is that a time frame issue, or is there something fundamentally wrong in my base assumption? And from a policy standpoint, how do I document that, right? Meaning like in March, right? I mean, let's just take something simple, like any volatility assumption got blown out in March, right? But I think we still, as an institution, have to have a process that notes that, discusses that, addresses that, right, as part of your we've talked about enterprise risk management, right? That brings that investment. Now, this is more kind of investment oriented risk, but how's that reported? How's that reflected upon, right? What actions, if any, are taken because of it? And action may be do nothing, right? We think it's temporary or it's within our range of error assumptions around the variable, right? But I think the main thing is how's that being tested, measured, right? Reported, right? I mean, to me, those are the important issues as a board member, right? So I appreciate Bill bringing up the question, but I think the challenge is how do we report on it? How do you track it? How do you show that the assumptions that you're making are sound, right? So that in the future you can improve them if they're not, right? But I don't think we always do a good job of holding those prior decisions and memorializing those and testing them in the future. What tends to happen is, oh, they weren't right, so we change them in the future, right? But if we don't hold these different things along the way, yeah, we may not capture everything we need to capture. Does that make sense?
Yeah, Alan, that makes sense. And I think, I think, and ultimately that's what we're, this, if you look at this slide, I mean, basically this is our first kind of, dip into the pool into trying to capture this. And, the challenge that we put to our risk team is how do we push this, further and further back? And how do we make sure that there's a cumulative, that we're able to see this on a cumulative basis rather than just in a snapshot in time? And, we've had some early results on that, but we just, we want to make sure that it's fully baked before we get to the point where we start showing it to you guys. But, I think but again, even with, just like with asset allocation, I think what you hit on is, if our assumptions are wrong, we change something, and I think we've kind of fallen prey to that, especially when it comes to things like asset allocation, where, the assumptions change, so we change accordingly. And, trying to move away from taking a shorter term, approach to whether it's asset allocation or risk or whatever, I think that's all part and parcel of how we're trying to move this thing, to move the thought process for the organization and for the commission to a different place. So.
Yeah. Well, and I bring that up because, I mean, this gets back to sort of risk modeling, like on a volatility assumption, right? I mean, it was statistically obvious to everybody, right? Vol had been suppressed at very low and abnormal levels for an extended period of time, right? And just the law of averages say, okay, well, how do you get back to average? I mean, and what your risk process should say, well, there are actually multiple ways to get back to average. One, I can go really high, right, for a short period of time, right? That would bring me back to an average, or I can go slightly above average and sustain it for a longer period of time, right? And those two worlds are distinctly different. I'm going to get back to that same long-term average, to your point, right? It might be a perfectly fine 20-year assumption, but shit, I mean, 20 years is a long time, right? I mean, that could be, 19 years of pain and then one good year, right? And so I think the purpose of it is not even what the end result is. It's about the process you go through to get there, right? Have you thought through how do you get there when that risk event is realized, right? Okay, I can go really high, short, and vicious, or I can go slightly higher than average and sustained, but I kind of know what the long term might wind up looking like. But those price paths are quite different. Back to this 2-year period, right? I mean, those are completely different price paths, but ultimately the math is going to drive you, back and forth across average over time, right? I mean, that's just the nature of it.
Yeah, and I think the thing to that. Kudos to, the risk team and to Jeff and guiding, us in this direction too is, what you're seeing on this slide, it's not that this didn't exist and that this wasn't happening. It's just that we weren't reporting on it, right? And we just weren't seeing it. We weren't measuring it, right? And what gets measured gets managed. So, this is how we're trying to build that out to have for the commission to have a a greater degree of oversight of the portfolio in toto, so, and this is kind of the initial run at it. Obviously more to come, and we're trying to drive it further and further back. So, I think that's but, this is, we were talking about this to Mr. Condon yesterday, seeing it this way is not something we've ever done. I remember the risk slides used to be, there was one line that occasionally it looked like a flat line on an EKG. It occasionally blipped. So, I mean, this provides us with a much greater degree of look through to the portfolio. So, but I think as it gets more and more robust, I think we can decide ultimately over time, what does it tell us and what actions do we need to take in response to it? So,
yeah, I would just add a couple of observations. We looked at this 9 months ago, and I believe there was not a number on the page above, was it 8%? Or 9?
Yeah, back in for December, there were none of it was above 9.
So these move around, and I don't want anyone to believe that when you're looking at something over a 2-year time period, you're always going to get the same read that you expected to get over 20 years. In the last 2 years, investment grade bonds are up 8.5% annually. High yields only up 4 3/4. So is that normal? It is not normal. Over 20 years, it looks like the opposite. So correlations are highly unstable at interesting times like we are in right now. And I just, this at a time like this is very informational. It teaches us about our portfolio, and I want to make sure that we're sharing all of that with you. This is not something that I would use to make 20-year decisions off of, 2 years of risk statistics. So,
no, but within that, Jeff, I mean, I think that's the challenge to a degree to you as the CIO, right? Like the effects we're seeing are what I would say. I mean, it may be atypical how we got here, but the market was looking for a recession to start this year. It just didn't expect the government to push us there in one fell swoop in a month by shutting everything down, right? I mean, the market was looking for kind of a 2 or 3 year recessions, and it's normal for investment grade to outperform credit, right, in a recession, but recessions tend to be relatively short compared to expansions historically, right? So anytime we're setting that long-term policy thing, right, it's always going to naturally take us to more risk over time because, in general, the economy expands more than it contracts, right? But, contractionary periods have a very definitive look and feel, and this one's no different. Like I said, the only thing that made it different was the speed because the government shoved us over the edge, and then they've thrown trillions of dollars to get you back out, right? It's kind of like, all right, I'm going to dig a hole, throw you in it, then I'm going to throw dirt back in it, and hopefully you can climb out fast enough, right? I mean, but the effects, and that ultimately comes your job of how much do you manage that. But from a policy standpoint, we have to realize the bias is always going to be longer, to Bill's point, to be longer risk, right? Because over long periods of time, you tend to get paid for that, right? But I think that you also have to rein in that bias a little bit, right? At times, right? And I think that's the big takeaway from Bill's point, right?
Absolutely.
Okay, any other questions or comments on our quarterly investment performance update? If not, I'm going to move to the next item on our agenda, which is the strategic investment topic presentation, and I'm going to call on Mr. Hitchcock to lead that, and rebalancing will be the topic.
You're about to get a presentation from Makita on rebalancing, and we asked them to, we gave Makita the charge and asked them to, present to us on kind of the different rebalancing philosophies and disciplines, and how, especially time periods over which institutional investors like ourselves rebalance, and whether or not there's a significant significant reason to adopt one time period or the other. So I'm excited to hear what they have to say and for them to present to the commission. Just to give you the bottom line up front, though, when after they're done with their presentation, we will be asking the commission to consider allowing us to move from monthly rebalancing to quarterly rebalancing. And, a couple of reasons why is, with the 5 asset class portfolio now, 2 of our benchmarks, for private equity and real assets are quarterly benchmarks. Also, given that to get a kind of more complete understanding of where we're positioned with our private markets assets, getting marks and having those marks over a quarter give us a much better snapshot of where we are before we rebalance. We don't think that there is any meaningful difference, that it makes any meaningful difference to performance, which you can certainly be the judge of that based on Makita's presentation, but we do think that is a better tenor for us to rebalance over. So all that being said, turn it over to Makita for their presentation.
Great, thank you. And good morning, everybody. I hope you're all having a safe and happy and healthy holiday season. As you know, I'm Allie Wallace-Stone. I'm a consultant with Makita, and I work closely with your investment staff and with my colleague Leroy Brantley on this relationship. So with that said, I'm going to start on page 43 and just kind of highlight the background, as Mike mentioned, pertaining to your rebalancing structure currently and just where we intend to go going forward. So as we talked about within Jeff's presentation, your current fund is rebalanced monthly. In addition, you're using your public equity assets as a holding place for private equity capital calls. And so you will periodically see an overweight to public equity in anticipation of future private equity capital calls. We reviewed rebalancing techniques significantly in terms of data, which we'll present to you, as well as kind of what your peers are doing, what other similarly sized public pension plans are doing throughout the country. And ultimately, we're recommending that you move from a monthly rebalancing to a quarterly rebalancing strategy. The proposed change in rebalancing frequency will reduce the transaction costs of the plan. It'll align more closely, as Mike mentioned, with your quarterly valuation of private markets. And it will also be more consistent with rebalancing policies of other large institutional pension fund peers. So if you jump ahead to the next page, the rebalancing overview page, you'll see here, we do lay out kind of what it looks like if you have a buy and hold strategy. So the chart at the bottom shows a portfolio that starts off at a 60% equity, 40% bond portfolio. And over time, it migrates up to over 70% in equities. Obviously, this is desirable if the market's going in just one persistent direction, but that's very rarely the case. And you can see in this example, you get up to over 70% just in time for the global financial crisis. So obviously, not desirable to be increasing your risk appetite in time for a potential rebound in the market. With that said, we believe that a disciplined rebalancing structure, similar to what you've employed in the past, but maybe just less frequent, is desirable to maintain the risk appetite that you guys have adopted after much analysis and review in your asset allocation. The next page provides an overview of some of the rebalancing strategies that we see. The first segment of rebalancing strategies that we see is systematic. It's based on kind of a rules-based approach. Oftentimes it's based on a time period. So like we're talking about today, monthly, quarterly, semi-annually, or annually rebalancing your portfolio to your targets. Other plans employ a range-based, which is if you fall outside your target allocation range, you'll rebalance to target or potentially to a midpoint of a target. And those are the two most common rebalancing tendencies of plans. The third is a risk-based approach. and it uses a variety of risk metrics to evaluate whether or not it's prudent to rebalance at that point. One way that it's oftentimes employed is for plans that have risk budgets established, but generally this is much higher, much more difficult to monitor and to prudently implement. The second segment of rebalancing techniques is active or tactical rebalancing. Probably heard a lot about that. Generally, we're not huge proponents for tactically rebalancing the plan, or I'm sorry, opportunistically rebalancing the plan. So trying to make frequent adjustments depending on valuations. Obviously, it's really difficult to time markets. And so both tactically or opportunistically rebalancing is rarely rewarded when you look kind of holistically over long-term periods. The next page shows kind of the capital-based rebalancing techniques. So we evaluated just about 40 years worth of data to determine what the impact of rebalancing strategies have on overall plan performance. And you can see the monthly rebalancing is the first one, and we also do quarterly, semi-annual, and annual, and then we have a buy and hold. And you can see everything outperforms the buy and hold because of the tendency of markets to revert back and have volatility in them. So it's prudent to be rebalancing. The frequency at which you rebalance, there's small deviations in the performance, and you can see on the far right column, we show the number of rebalancing actions over the designated time period for each of those. And you can see that the third column in the cost adjusted annualized return is interesting over this time period because it accounts for the potential cost associated with rebalancing and the frequency at which you rebalance. So you can see monthly underperforms quarterly and semi-annually and annually as a result of those transaction costs. So we think generally it's prudent to rebalance quarterly in order to reduce transaction costs, but also to avoid potential volatility in the market, and recognizing that annual may be too extended of a time period to rebalance. So with that, I think I will turn it over to my colleague Leroy, and he can start on the next page and just kind of further evaluate some of the data that we've run in this analysis.
Thank you, Ali. Can people hear me clearly?
Yes.
Yeah.
Oh, excellent, excellent. So as Ali referenced earlier, there are a number of options here. I should also say my name once again, Leroy Brantley. I work with Ali Wallace Stone on the account. And today I'm just going to give some more granularity on some of the other options that are available for rebalancing. And this more or less focuses on the range rebalancing approach, which is used by a lot of institutions instead of having a periodic place where they go in and perform rebalancing monthly, quarterly, semi-annually, or annually, or not at all. This is an approach where you're triggered by thresholds. And what this essentially means is that you have a target. Say, for instance, for our public equities, we have a target of 48%, and those ranges are 30 and 60 as a minimum and maximum threshold. And if we were rebalancing in that way, if we were to violate and have less than 30%, we would have to rebalance. And if we had more than 60%, we would have to rebalance. But let's just say for the ease of numbers, we're looking at equity numbers at 25%, and the range is at plus or 5 minus percent. So that really means that the thresholds are at 20 and 30%. And when you have those thresholds at those points, that would require an action. And when you're looking at this, if you have all of your asset classes are within those thresholds for each of them, for each of their respective thresholds, there's no need to rebalance, is essentially what happens. But here, you can have a variety of actions, and first of which is to do a midpoint. The midpoint is seen as more of a gradual approach meaning is sort of less drastic, if you will, or less severe, because you don't move right back to target. So let's say if we had a plus or 5 minus plus a 5% range that we're doing, and we went below that 20%, instead of moving back to the 25% that I mentioned, we'd move to 22.5%. And likewise, if we violated the 30% upper bound, instead of coming back to target at 25, we'd go to 27.5%. And the target option, you would obviously just move right back to target. So, and that could be a situation where it's a very volatile asset class, and moving back to target could have you endure a lot more volatility, and this could be a cost situation as well. The endpoint approach is an interesting one, because that would just have you move back to the endpoint instead of approaching the target. If you're over 30%, you would go back to 30%, and if you're below 20%, you would move back to 20%. So when you're dealing with the endpoint option, that can become an issue because you're right at the very tip of where you're allowed to be. So if you're to look at the number of rebalancing options, say for instance for the plus of 5, you're doing 85 actions here, as opposed to 25 for midpoint and 18 for your target. As you will see, the midpoint for both the plus of 5% and plus or minus 5%, or plus or minus 10%, the midpoint tends to get you a more attractive cost adjusted return, and that's highlighted there. And in addition to that being more attractive, the standard deviation numbers are lower for that as an option as well. But as you will see, the buy and hold approach, where you're essentially letting the market rebalance for you, that is the least attractive in terms of returns, but obviously the most attractive in terms of costs, because there are none. We can move on to the next slide. Here we give you a backdrop of using the global financial crisis during that time period, and just seeing how this would play out. The midpoint numbers hold up, and the buy and hold option is once again least attractive. So what this essentially tells you is you have to have some form of discipline, because if you allow the market to rebalance your program for you, you end up doing not as well. If you were to look at the monthly options on a cost adjusted basis, this is the one number that's actually less attractive than the buy and hold approach. So in terms of looking and choosing during a period that we know was a very trying period, here the monthly appears to be the option that you would not want to have. But moving further down, you have some interesting numbers when you look at annual. And here, the annual one, it's really your success or greatest success is more predicated upon which months that you choose to do this. And when you're doing an annual process, you do have to have that month, and you do have to stick to that month. But if you were to look at how these programs performed, October perform least well, because in that number you would include October 2008, and you would have been forced to push into equities, and that would have been right before the crash, and that would not have gone as well for you. Say, for instance, if you had April as a month, would have been a fortuitous month to have, because that would include in it April of 2009, which was the time to go back into the markets. But having withstood essentially 8 quarters of down performance, a lot of institutions were pretty shell-shocked, and there's a lot of trepidation on re-entering the market. But if you had a rebalancing discipline that would have forced your hand, you would have come in at a great time for equities to have a tremendous rebound. You could flip over to the next page, please. Hello? Oh, there we go. And here we have the, there we go. We have the NASRA numbers, the National Association of State Retirement Administrators. Here we're looking at 47 large public plans as a point of reference. And interestingly, 94% of these plans, 44 of them, use some form of range basis, not periodic. We were one of 3 that used a periodic basis, meaning monthly approach. And we were the only one to use a monthly approach. And this variety of approaches sort of moved the whole gamut between target to midpoint to endpoint. So there was not really a theme that came out of this. What it essentially tells us is that every plan is different, and every plan chooses an approach that best fits their respective needs. So with that being said, final page here. There are many approaches here. Many rebalancing options are available. We feel that the monthly plan has been effective for us, but we think the quarterly plan would be one that's more cost effective. And on top of that, we have a fuller and more panoramic view of the portfolio in terms of actual market values, because of the privates being mark to market on a quarterly basis. We have a more exact set of points of reference. So as Ali said, our recommendation is to move away from the monthly frequency and move to a periodic amount of quarterly rebalancing. More than happy to answer any questions. On those slides, we realize there's a lot of information there, but as I said, we're more than happy to take any questions here.
Yeah, do you mind just the not the periodic tables, but the sort of policy-based tables? Can we look at those again? And just since your summary is your recommendation seems to be the quarterly, just can you go back through how these compare directly to the quarterly, since we sort of summed it down within that universe?
Yeah, that's one of your slides, Ali.
Am I in the right place here, Ali?
Right.
I think he's actually maybe talking about the next slide, where you talk about the difference between range. Is that right?
Correct.
Oh, okay. So what's your question? I misunderstood it.
Yeah, range relative to quarterly, right? I think seems to be it seems like y'all's recommendation is to go to quarterly, right? In part because of private stuff. And I have 2 questions about that, right?
Right.
Only touch on the month stuff, but even on a quarterly with private equity, there's still going to be a delay. So presumably you'd have to be the middle month of the quarter. Not that I think we should base it on that, because to a degree that's just a random variable. But as a policy matter, I think it would practically, unless y'all tell me otherwise, Jeff, that I would assume we'd have to be the middle month of a quarter, right? Because the lag on even estimated roll forward for the private equity piece.
Alan, you mean the lag between quarter end and when we get marks?
Yeah, when you get marks, so you know how to rebalance, right? Presumably you're the middle of the quarter, right? So it'd be a quarterly routine on the middle month of the quarter, right?
I think it would be even longer lag. So that to me makes it even harder. Asset class by asset class, you're getting your your credit marks before your PE marks. Yeah, so, but I don't want that to derail it.
No, let's be clear. What this means quarterly is, as opposed to doing this 12 times a year, is that we're going to do it 4 times a year. And it's not necessarily, a March, June, September, or December period for doing it, but we're doing it 4 times a year. Does that clarify?
Yeah, I just didn't know how codified people
Right.
in policies related to it. So if you're going to fully codify it, right, you'd want to make that clear, right?
Right. So one of the tools that you cannot do this without would be the performance report itself, just so you know from an asset allocation standpoint where you are. And the key difference here, if you're looking at the differences between saying you have a periodic sort of mandatory period for a point of action where you're supposed to do something. Here you could, if you have the range balance and that's your approach, you could have that quarterly period sort of mandated as your point of frequency. But if you get there and all of your asset classes are within the allowable range, you could do nothing. Right? And similarly, the main difference here is folks that would have the periodic approach would more or less look to move closer to target as opposed to a midpoint or an endpoint. They'd look to move closer to target. And, obviously you're going to have a situation like we have where there's going to be an imbalance for private markets because most institutions are not at that weight for those policy levels and really can't get there. It's not a question, as Mike talked on earlier, our main 2 levers that we pull for rebalancing are in public equities and public debt. Otherwise, those targets for the private markets are based on a net asset value, and we can't just give the managers more money and get to that level. We have to wait for that capital to be called. And the other part that gets a little bit tricky there, that's a good problem to have, is getting net distributions back. Because when those distributions come back, that actually brings down your net asset value or your NAV as well. So, it's a hard discipline to keep, especially when you have volatile markets. And we saw the benefits of what rebalancing can do for a program just with what we saw at the beginning of the shelter in for the pandemic, where markets cratered in March. And in most cases, those equities violated the bottom threshold, the bottom limit for their allowable ranges. And most institutions were forced to go back in. And if you had the intestinal fortitude to do so, you had full benefit of what happened in April and the subsequent months in the global equity markets.
So, Leroy, I want to make sure that we connect a dot here. That's important. Is the motion that was circulated is a motion that would change the way that our policy benchmark is calculated. And the point of that is that I believe that the way that the benchmark is calculated and the way our discipline on how we rebalance should conform. So I just want to make sure that everyone's clear that what we're really talking about here is aside from the rebalancing, which is an important thing, but it really is conferred upon me and my team through the SIOP that this is how we codify the commission's expectation of the frequency or the parameters of rebalancing. I'll call it the parameters of rebalancing. And I think in that context, it works best as, you know, the discipline, the time-based discipline. And again, with our private equity and our real assets portfolio benchmarks working quarterly, that is a big part of the, you know, the rationale for trying to have this whole system conform to itself. So I just want to make sure that I'm connecting that dot.
Yeah, I would agree, Jeff. And, oh, sorry,
Yeah,
Mike, go ahead.
Yeah, I was gonna say, the actual motion is really, is very simple and it's targeted, you know, where we would, in the rebalancing policy that is in the SIOP right now, it would just simply change monthly to quarterly. I mean, the effect of that is, but the overall impact of that would be, is that our rebalancing would conform to a quarterly, which would lead basically to a quarterly policy benchmark. And given that we are reporting especially to the commission on a quarterly basis, this lines up everything and makes everything congruent. So, I mean, if you get down into the meat of the policy, you know, there is a degree of discretion that, you know, that even though there's right now there's a requirement that we rebalance, or there's an expectation that we rebalance monthly. You know, there are circumstances by which we can deviate from that if we, you know, if it's an inopportune moment to do so, not from a market timing perspective, but if there's so all we're in essence asking is, let's change in the SIOP monthly to quarterly, and then that'll make everything much more congruent.
Yeah, the flexibility afforded to me via the ranges around targets gives me the ability to not rebalance or rebalance mid-month. I have that flexibility, and it is a great tool to have, and we use that on occasion when we think that markets are ahead of themselves, or there's an opportunity to rebalance in advance of month end, or even to deviate from the target. So we have the framework in place to permit kind of alpha oriented deviations. But I think that what we're really talking about here today is what is the discipline that the commission thinks makes sense for rebalancing frequency in policy. So I just want to, return to that, and our recommendation, of course, or the recommendation of Makita that I agree with, and Mike, I think you agree with, is having all these things conform on a quarterly basis is what's rational.
All right. Any other questions on this topic? I'm going to ask.
Yes, I have one, Mr. Chairman.
Go ahead, please.
This is Bill Condon. Yeah, if the only change is monthly to quarterly, that sounds good to me. But I don't know that I understand rebalancing as a whole.
Hey, Bill. Bill, we're sorry to interrupt you. We're having a little technical issue. You got you got kind of a weak or garbled signal there. Could you back up a couple of sentences, please?
Yeah, that's probably my fault. I joined through the computer here and it doubled up. Sorry.
Yeah, is this better?
Yes, please go ahead.
Okay. Yeah. Changing to quarterly sounds good to me, but I don't think I understand rebalancing as a whole after this discussion, and maybe not just after this discussion. We talk about these benchmarks that don't necessarily, that are only quarterly, and I think that's private equity and private debt. But I think it was Leroy that said it, or maybe just implied it, that how do you rebalance private equity and private debt? Because you got to wait till capital calls and distributions, and you just can't change those. So that's one question is does rebalancing really apply to those for private equity and private debt? Now I know we need to get back into ranges if we're outside of a range, but my guess is we rarely fall out of an authorized range because they're pretty wide. It's probably just moving within the range. And then my second question is per our policy, per the CEOP, it looks like, I just want to confirm that rebalancing, all the CEOP says is just to rebalance within the approved range. So we're not rebalancing to target, for example, 46% to public equity. We're just rebalancing somewhere between 30 and 60%, which I think is the range. 30 and 60%. Can Jeff or somebody address those things?
Bill, I'll take a shot at it, and then if Jeff, if I miss anything, then I'll hand it over to Jeff. Ultimately within the SIOP, and what we're trying to get to is, and hopefully this is responsive to your question, but ultimately what we're trying to get to is you're right, that we can't sell when we're rebalancing, and I think I alluded to this earlier. The two levers that we have ultimately to rebalance are public equity and bonds, right? I mean, we're not necessarily going to find ourselves selling into a secondary market in order to try to trim private equity, right? But the way that we look at it is that the private, those private asset classes, like for instance with private equity and public equity, to the extent that we would be overweight private equity, right, we would then be underweight public equity. So there's a linkage between the public and the private asset classes in that instance. So, and our discipline is that we employ is that we try to rebalance as close to target as possible, if it makes sense, within on a monthly basis. That doesn't, and you can see from the exposures that we looked at earlier, we don't necessarily hit that with pinpoint accuracy, and hence the ranges. But what we're really trying to do here is the frequency within which we assess those decisions, right? Within the I guess the flexibility that the policy provides, the frequency within which we assess those decisions, and the expectation of the commission of the frequency by which we would do that. We just want to move from monthly to quarterly, so that we can, we have more information in order to make a more accurate assessment, both the actual weights as well as of what we're actually have, and the where the benchmark is, right? So that's that's really all we're asking for. So it's not necessarily going to change how we approach it, just how often that we approach it. Does that make sense?
Well, it just seems like to me that your explanation just kind of confirmed what I thought, that we really don't, unless it's outside of a broad range, we don't really rebalance private equity and private debt. And I'm not sure that doesn't seem to be clear.
Bill, can I give you an analogy for the difference between public markets and the less liquid things? And unfortunately, I'm from the north, so I'm from Iowa, where it snows a lot. And growing up, we always had rear-wheel drive cars, and that is quite an experience on snow and ice, let me tell you. So the difference is, if you have four-wheel drive versus rear-wheel drive, you're going to be able to drive with a lot greater ease. Private markets, we we arrive at the exposures we have based upon commitments that were made over many years, right? So the only way that we really would be able to control the magnitude of those exposures is by selling. So we try not to do that, but we will contemplate that in the form of a secondary sale. So you have more tools available to you in public markets. And that's where the overwhelming majority of the rebalancing activity is going to occur. So, but trying to tack back to your question here, what we are proposing is, and since we are going to be judged against the policy portfolio, it's basically what does the commission want to put forth as that benchmark against which we will judge the investment decision making that occurs, that affects the implementation benchmark and ultimately the actual portfolio. So the only thing we are asking is to change the frequency with which we try to trade back to the targets, because if we don't have an opinion, you can expect that that portfolio is going to look as close to that policy benchmark as we can get it. The only time that we drive the portfolio away from that intentionally is when we have an opinion that something is uniquely attractive or uniquely unattractive. So that would be, so we separate rebalancing from tactical, where we are trying to make it look different. So think about where we have no tactical views to express. With what frequency do you think it makes sense for us to make that portfolio go back to that target portfolio that the commission outlines in the form of the policy benchmark? So for us, we don't think that there's any material difference in risk between doing it monthly, quarterly. We think there could be a small improvement to the performance as evidenced by our consultants' work. So we just think that it's a logical continuation of what we're doing. And if we want to continue to periodically talk about different rebalancing methodologies, we can certainly do that. But I know we're running the risk of beating the dead horse here, so I want to be merciful to everyone. So that'll conclude my comments. But is that helpful to you?
I appreciate it, but I just don't think I understand rebalancing as a whole. So that may, so hence I'm not sure that's going to be corrected today. My lack of understanding of what we do.
Yeah, Bill, I think probably what might be good is just to, have us do a offline, kind of education session, and, we can talk about it, and, and then spend as much time as you would want to get comfortable with in really how, and knowing and understanding how we do it. So we can definitely set that up if that's something that you would like to do.
Yes. Thank you, Mike.
Yeah. So that's no problem. And we'll offer that up to, obviously, to anyone who would want to partake as well.
Okay, folks, any other comments, thoughts, or questions on the rebalancing? Okay, if that's the case, I'm going to ask Mr. Hitchcock to read the motion that I'm putting to the floor.
Thank you, Mr. Chairman. The motion would be to amend the SIOP to provide for quarterly rebalancing rather than monthly rebalancing, and authorize staff to make any technical revisions or formatting edits consistent with the action taken by the commission.
All those in favor, please signify by saying aye.
Aye.
Any opposed? Any opposed? No.
No, this is Bill.
No noted. The motion carries. At this time, without objection, I think I want to let's get about a 10-minute break in. Is everybody okay with that? 10 minutes, we'll come back at the clock I'm looking at says 11:21 right now. We'll reconvene at 11:31. Okay, 10-minute break, everyone. Mr. Hitchcock will lead, and it's involving the issue of Chinese public company investment discussion. Mr. Hitchcock.
Thank you, Mr. Chairman. I think as many of you may recall, over the past couple of meetings, we've been engaging somewhat off and on a discussion regarding the risks associated with investing in Chinese publicly traded companies that are listed on U.S. exchanges. And I wanted to give the commission an update and also make a recommendation put out for discussion by the commission as to how we should go about that, or how we should move forward in regards to that. As many of you may have, one of the things that we've been doing over the intervening times as we had this last discussion is monitoring the regulatory action of both. There's really three pieces to it. The administration, and in particular the SEC, not only the SEC, and as well as some action that was being considered by Congress in this area. Really the concern around this really focuses on, just to remind the commission, the concern around this really focuses on the transparency that the PCAOB, which is the Public Company Accounting Oversight Board, has into the underlying audit papers of Chinese public companies that are listed on American exchanges. And that there has not necessarily, for many of those companies, has not been the transparency that would be the standard by which American companies and other companies that are listed on U.S. exchanges are held to, and that there's concern about which has led to concerns about valuations and things like that in regards to those companies, and that increases that lack of transparency increases the risks of being invested in those companies. So the SEC, along with the PCAOB, raised this issue a decent while ago, but there's also been action taken by Congress and action taken by the Trump administration on a similar but slightly different concern in regards to Chinese public companies. So just to kind of summarize where I see the landscape right now, President Trump a couple of weeks ago issued an executive order banning U.S. persons and entities from investing in 31 Chinese companies that are publicly traded. Now, this investment would not necessarily just be limited to whether or not they're listed on U.S. exchanges, but would really just be a general prohibition against investing in these companies, period, regardless of where they're listed. It's my understanding that I think it was either Friday or over the weekend, just this weekend past, 2 more companies were added to that list of 31. The SEC, so that's, and the basis by which those companies, that prohibition is based on is that those companies have significant ties to the Chinese military. So, and that they pose that by investing in those companies, you are in essence supporting the Chinese military. The other concern and the actions by the SEC and the PCAOB, the SEC has been looking to promulgate emergency rules to address the transparency issue. But just last night, the House passed a Senate bill that had passed the Senate back on May 20th. And what that bill provides is that Chinese companies who are listed on U.S. exchanges who fail to provide the transparency into the underlying audit papers that is the standard set, which would meet the standard set by the PCAOB, for 3 consecutive years in a row would be delisted from U.S. exchanges. So they would not be able to, they would be delisted. They would be able to come into compliance and be relisted. But if they ran afoul of those underlying transparency requirements again, then they would suffer I believe it's a 5-year delisting penalty after that. And so they wouldn't be able to cure, wouldn't be able to cure that over for at least 5 years. It also requires, the bill also requires these companies to list any association that they would have with the Chinese Communist Party. So for instance, for example, they would have to provide a report that says whether or not any members of the Chinese Communist Party are board members, and to really describe the association that they may have with the Chinese Communist Party. So that legislation passed the House. There's a requirement that within 90 days that the SEC promulgate rules in order to provide for the enforcement of those, basically of the law. So the SEC will be looking to do that over the next 90 days. Now, the thing that I think makes this interesting, that I obviously with an incoming administration and in regards to the executive order, there could be some question as to whether or not that executive order banning the investment in those 33 companies that are associated with the Chinese military will stand. So there's a little bit of uncertainty around that. The bill that passed regarding transparency passed by a voice vote in both the Senate and the House of Representatives, and it's on its way to the President Trump's desk to sign, and he is expected to sign it. Given that it passed on voice vote in both houses, that means that there is tremendous bipartisan support for this. So we would expect, or I would expect, that this to not only to stand, but this to be something that that will have to be dealt with over the ensuing coming years. For both the prohibitions under the executive order of investing in those companies, investors do have until November of next year to divest from those companies. I believe after January, there's a particular date in January by which you can no longer invest in those companies. But if you already hold those securities, you have until November of next year to divest. Obviously, with the new legislation, it's going to take, in regards to the transparency, it's going to take, a company failing. And the one thing that I looked at the legislation, and the one thing that I was not necessarily clear as to whether or not the 3-year period of non-compliance is retroactive or is prospective in operation from the date of the passage of the bill. But there's, either way, there would be some time to deal with there has to be obviously a list of those companies that would be put forward by the SEC. So there's time to address that action that could be taken against other companies. We feel confident in our discussions with BlackRock and State Street and others that that we believe that should these prohibitions stand, and should there be a prohibition against investing in other companies, that there will be that the index providers will take this into consideration and provide a ready solution for this. One of the things that we don't want to do is, we don't have any particular expertise and that we bring to bear in Chinese companies that have close associations with the Chinese military or lack the transparency of the PCAOB. The regulators in Congress and the administration are hard at work trying to establish these lists. We feel like that those will be reflected, and that there will be an economically suitable solution that will be provided to avoid investing in those companies, that will not take us away from the simplicity that we have built into the exposure that we have, that are basically our public equity portfolio, the way that it's implemented now. We don't we don't want to try to get ahead of the regulators and the index providers and institute a solution that will in essence unwind that that simplicity and those cost savings that we built into the portfolio by implementing an all passive solution in regards to, you know, by just investing according to the ACWI index. So all that being said, ultimately, my recommendation would be for us to continue, and I'm, you know, this is really just trying to get the sense of the commission. My recommendation would be for us to continue to monitor the actions by the SEC and as they promulgate these rules around the transparency issue, and also as the prohibition under the executive order for the other companies associated with that are supposed to be associated with the Chinese military work their way through, that we would just say that, you know, let's continue to monitor that. We believe that a for lack of a better word, cheap and easy solution will reveal itself for us as we move forward, and that we'll just simply avail ourselves of that in order to avoid these and, you know, to avoid our having investments in those companies. So hopefully that's a path forward that the commission sees as beneficial, but would certainly open it up to questions or discussions.
Questions for the CEO? Do we have any?
Yes, this is Bill.
Hi, Bill, go ahead.
Hey, I was going to wait to let other people, since I've already asked a lot of questions, but yeah, I think continuing to monitor and all that sounds good. You know, I would add that I think at least I need or want and have expected, based on the last time we discussed this a couple meetings ago, to have some more education on these matters. You know, I think our risk goes, first of all, it might be a great time to invest in China. I was just reading about their Made in China 2025 plan, and they you know, they want to modernize and basically within the next 20 or 30 years dominate manufacturing and innovative technology in the world. So might be a great time to invest, but just the delisting, the act passed by Congress. If here's where I need education. If somebody gets delisted, say Baidu gets delisted, and I don't even know, I guess they're on US exchange. They just go to London or Hong Kong, and then we buy them there. So nothing. So our risk hasn't changed. And also there are other companies out there, other Chinese companies out there who haven't listed in the U.S. that have just listed in Hong Kong or London or Luxembourg or wherever they go to, and they don't properly disclose, well, in accordance with U.S. standards, properly disclose. And I would assume, based on the index we're following, we probably could buy those. You know, they're not subject to U.S. SEC or AOB, so we could buy those. So I'd love to understand more about that, the different exchanges, and whether those risks that I just stated are real. You know, I read a congressional research a paper yesterday that was just written within the last 3 or 4 months, and it listed a lot of concerns, some of which we've talked about, but a lot of them, you know, talked about how non-transparent the Chinese government's role is in Chinese companies. So it's very hard to figure out the role, even if there's some kind of formal role. their influence over companies are great, so they could still influence actions, and that influence might not be in the best interest of shareholders, of value, because they have other goals. So I just think there's and I think I'm just plus 2 meetings ago, I talked about a list of risks that I think the SEC or the PCAOB put out, that I later provided after the meeting to either Mike or directly to Makita, and I thought we were going to, somebody was going to look into all those risks. So I think there's a broader education that I would like to see. So
Bill,
I'll just
I'm in 100% agreement
stop
with
at that.
Bill, I'm in 100% agreement with you on the education piece, and I think to go back to something Mike said a little earlier, we're going to be looking to State Street and BlackRock to address these concerns with us. We can't be the only relationship with those folks that are having these same issues. And so I would imagine that they either have or are working on some options or a solution for us. And that's what I'm going to be looking for in the future. And I'll be raising those questions to our senior leadership here until we get those answers. We get a satisfactory answer to those questions.
Yeah, and Bill, kind of to your point, the thing that I think, in the question of it's pretty, like, the question of the companies that have, and the one thing that I let me back up for 1 second. The one thing that I neglected to mention in regards to the legislation that I think has gotten a little bit lost in the headline is the other thing that the legislation requires is that, companies that are traded on, Chinese companies that are traded on U.S. exchanges would also have to list, and I don't know if I said this or not, but board members that would have to describe their association with the Chinese Communist Party, like board members and, those types of things as well. So there's an information component to it too. But one of the things, it's pretty easy. The solution is pretty easy with the companies that have associations with the Chinese military that are the subject of this executive order, because you can't invest at all, right? I mean, regardless of where they're listed, you can't invest. So that's a prohibition for U.S. capital to flow to these companies. The thing that I think is to a certain extent on the wait and see, and to your point about whether or not these companies just kind of flee to either go back to either list on the Hong Kong exchange or some other exchange, and we could still potentially have exposure to them that way. I think kind of the flip side, I think the thing that we would rather see, given especially some of these companies that could be subject to this, like Alibaba, Baidu, some other very large, companies that are in essence, Alibaba, basically the Amazon of the Asian world. I think what we would probably rather see is them come into this be the motivation or stick, for lack of a better word, for them to come into compliance so that they then, are in essence good corporate citizens, and we have that diversification opportunity and the opportunity to invest in those companies. So I think that's why, continuing to monitor and to see how these companies that would otherwise be subject to the PCAOB, oversight, or would have to subject themselves to PCAOB oversight, how that they react. Because if I think it is another question as to whether or not, like if an Alibaba says, well, we're just gonna forego listing on U.S. exchanges and we're going to London. Well, then that, there is a separate question about how does that impact whether or not we would want to have that exposure through another exchange. But I think right now it's a little too early to tell if that is going to be a risk or not. One of the things that we have done, though, is we have isolated our exposure to the 31 companies. I don't know if we added the other two, but the 31 companies that are subject to the executive order. And out of those 31 companies, we have the portfolio has about $19 million worth of exposure. So, not obviously, $19 million is a lot of money by anybody's standards, but in, kind of in comparison to the overall portfolio, doesn't really pose a substantial risk, that I think would require us to get ahead. So, that's why I'm saying let's wait and see, and then I think we can have a greater understanding once the regulations are promulgated, who would be subject to those, and then what action do they take in regards to that, and whether or not we would want to make the choice of, rolling back the cost the risk of rolling back some of the cost savings that we have built into the portfolio now in order to avoid investing in those companies is something that we would want to look at. But right now, we just don't have the ability to know, nor could anybody tell us right now what those ramifications are.
Well, what it seems like to me, though, is what you're talking about is what you're talking about is good, but I think it's just needs some additions, because what I think you're talking about are the companies that our government, the federal government, one way or the other, one branch or another branch or whatever, are identifying that they can't be listed or we can't buy. But I think, and we could just follow that, but that's where I think the education comes in. There are more risks than just what the government seems to be identifying. Well, Bill, I mean, that's where I think we need some of it. I mean, even the disclosure of whether their involvement with the Communist Chinese Party, this congressional research paper says that the Organization for Economic Cooperation and Development concluded that the Chinese state role is more pervasive in Chinese industry than formal ownership reflects because of the opaque nature of government shareholding and funding. So even if, and I don't know the rules, and they're probably not even developed yet, but if the disclosure is talking about disclosing formal ownership, here's the Congressional Research Service saying formal ownership's not gonna identify some of the problems, some of the influence peddling or influence that the Chinese government has over these companies. So we might need, and we may not even be able to figure that out, and BlackRock might not be able to figure that out. But I want us to understand those risks, and that's why I'm asking for the education. And I'm not sure BlackRock, whoever does it, I think needs to take it beyond just what companies are delisted and what companies are prohibited from investing, which is what our government might be telling us.
Well, I mean,
so
Bill, I think
in that.
I think my problem is that we don't, we obviously don't have that expertise, nor would we ever attempt to profess to have it, right? And, to the extent that, I mean, that's why reliance on the regulators who do have that expertise is what I'm suggesting. Because in essence, I think you're asking kind of for something that I don't know really how to provide you with. Because if it's not the regulators who can give us an indication on who's bad and who's good, I don't really know who can. Because, when we think about this in terms of when we've had other, when we've had Iran and Sudan and those types of issues where, our own General Assembly has prohibited us from investing in those companies, those prohibitions never extended to commingled funds, right? So, because we don't in essence own any of, RSIC has no ownership in any of these companies directly. You know, our ownership comes from the units that we have in the commingled fund that ultimately has some degree of exposure to these companies, right? So RSIC does not own stock in Baidu, you know, or Alibaba. RSIC owns units in a fund that have exposure to it, right? So that's why, you know, either we, and so there's never been a prohibition historically where we've been required to divest that would even require us to divest from a commingled fund, right? So we're even one step removed from direct ownership. So we don't, like I said, we have no active, we have no active equity that has exposures to these companies. We just simply own units in a fund. And, you know, we feel that those managers who manage those funds for us are ultimately in the best position to make those value judgments, and including MSCI, as to whether or not those companies can be included in their indexes, or that their exposure through the funds that we invest in, if those should be excluded. I just, you know, I don't know if you certainly welcome any suggestions that you would have from, you know, from people that you can think of that, you know, we may be able to reach out to, that you would want to hear from. But, you know, I don't just have somebody that can, I think, that I can think of that can give you what you're asking for, right? I mean, it's the risk is, I mean, I understand the risk is we're investing in we're investing in funds that are, you know, controlled by BlackRock and State Street, that simply, you know, have us indexed to the requisite components of those indexes and the underlying, and in essence, the underlying companies. But we don't have any direct exposure. So, you know, my thought has always been, to the extent that those companies run afoul of any of these prohibitions, they will ultimately get excluded from the index, so that the solution will ultimately work itself through.
Anything else? Okay, so let's move along. I'd like to recognize Jeff now at this point to give us the delegated investment report, please, Mr. Burr.
Sure, and this is just simply introducing the list of investments that were closed since our last meeting. And you can see here that we have 5 investments closed, each of which are private market investments. And I don't know if there's anything else to say, because we've already provided materials to each of you on relating to each of these. So, but I'd be happy to entertain any questions if there are any.
Questions for Mr. Berg about the delegated investment report? Hearing none, I'm going to call on Mr. Hitchcock to read the motion for this commission to move to executive session.
The motion would be a motion to recede into executive session to discuss investment matters and specific investments pursuant to SC Code annotated sections 91680 and 916-320, to discuss personnel matters pursuant to SC Code annotated 30-4-70A1, and to receive advice as needed from legal counsel pursuant to SC Code sections 30-4-70A2.
May I have a motion?
So moved.
That was Mr. Gillespie. May I have a second?
Second, Bill.
Second from Mr. Condon. All in favor of going into executive session at this point, please signify by saying aye.
Aye.
Aye. Any opposed?
Aye.
No.
We can meet in 5 minutes on a separate dial-in, or just immediately.
Yes, it's been suggested, we will be moving into executive session, but it's been suggested to me that we convene an executive session on a separate dial-in. I believe we all have instructions to do that, do we not?
We did.
Yeah.
If that works for everybody, we're gonna sign off here, and in 5 minutes, we're gonna reconvene with that separate dial-in. Talk to you in 5 minutes, folks.